Well, good morning, Wealth Press viewers, subscribers, traders, and investors. Welcome to another market wrap-up for this week. And Roger Scott joins me as usual. Roger, how are you?
I'm doing great, James. And again, thank you for having me on. How are you doing today?
I am well as well. Thank you very much. Roger, our conversation before we started this role is focused on some characteristics that the stock market is taking on that sounds like it has ominous implications for the future.
Well, James, it's my obligation and duty to tell you things I'm seeing, and I'm finally seeing something a little different. And you and the readers have to know about this. This is interesting, and it's just started happening. Not even beginning of this week. It started happening as the week continued. And I think, and I'll explain why, how, and all of that stuff as I go through with it. But for the first time, I look at everything from a relative strength perspective, and I have my CSI, my cumulative strength index scan. It gives me the 10 major sectors in the S&P 500. And so far this year, we've seen technology mostly lead. Technology has been the forefront, especially since post February, because technology and biotech is the NASDAQ 100. The NASDAQ 100 has been heating up, and it has become I would say it as, this is not, I'm going to coin this from Jeff Zinnineri, premium. The stay-at-home stocks are now the premium stocks. So we were seeing a large premium on anything involving helping the stay-at-home economy grow. But right. For the first time, James, this week, might have happened Tuesday, might have happened Wednesday, the consumer discretionary sector rose above technology. Now, I thought that was kind of interesting because, and I didn't really put too much into it, and I'll explain why initially. Because if you think about it, the further technology expands, the further technology develops, there has become a very big mix between technology and consumer discretionary. For example, Apple. Is Apple technology or is it consumer discretionary? Or Amazon, as you and I were just briefly talking about, is it technology? Is it consumer discretionary? So especially in the last 20 years, you've had a lot more tech in consumer discretionary and consumer discretionary in tech. And they usually move hand in hand. But technology has been every week, every day leading. And that's the reason is because the semiconductors, the non-consumer discretionary tech, the solid tech has really been the networks, the cloud storage, things that you really cannot put in the consumer discretionary sector. That's been moving higher and higher. And because of obviously things like Zoom communication, what we're on right now, that has been just spiking, or DocuSign, things that people need, technology that people need to continue working from home, as you and I have been doing for several months.
Yep.
But there is a shift. So what I did after seeing that, I started looking, I went from the CSI scan on the 10 major sectors, and I went on the S&P 500. And if you looked at the S&P 500 over the past 4 or 5 months, you would see mostly very heavy tech and biotech, especially in the first 50 spots, the 10%. Well, something different is happening big time. You know what the number one company is right now? It's L Clothing. Gap is in the 4th spots. Hanes, clear consumer companies. So what? And something else, FedEx and UPS, and I might have mentioned that last time we were on. Freight transport and retailers are now dominating it. In other words, if you were to look at, the point is this: if you were to look at the S&P 500, the top 50 versus 3 weeks ago or a month ago, it is becoming extremely broad. The point of this is technology, hard tech, the one that Wall Street was loving for the last 4 months, is starting to lose its concentration. And we're starting to see broader sectors like home builders, like basic materials, like freight shippers, like retailers. They are now starting to dominate the S&P 500. And when I say dominate, I'm talking top 10 spots.
Mm-hmm.
So, and that is a shift that we have not seen this year. Maybe in January. Don't quote me. We might have seen it in January. You know, this COVID pandemic was so hard on everybody. I'm kind of still jaded based on what happened after February.
Right.
It was kind of like the world before and the world after. And
Sure.
so this is the first time this has happened, James. And I have to bring it to your attention. I have to bring it to our readers' attention because
But
this is very significant.
Sure. Do you think that that's a byproduct of the fact that the valuations of tech has really, it's, what is it, doubled in the last year for the most part? The NASDAQ 100 has a 60-degree angle on that slope. And it's like, I've been watching that and thinking, well, quantitative easing aside and unprecedented volumes of liquidity aside, how can you justify continuing to drive a value higher when it starts to become, thousands of multiples more than the company makes? And so I wonder, to what extent is it actually sort of like value fatigue on the part of the investor class generally, where they're saying, okay, we can't keep putting this all into tech, and let's start to look outside of that. And I guess obviously anything associated with the increased capacity for staying and working from home and supporting that are the obvious beneficiaries. But now with even home builders and all these other things sort of piling on at the expense of tech, is this a trend developing, or is this just a temporary phenomenon in your opinion?
I do not believe that's a great question. I do not believe this is a temporary phenomena. And even if it is a temporary phenomena, I don't think I don't want to use the word ever. I don't think that till we get a vaccine, I think the deep concentration that we saw in tech is gone. I think that even if we narrow down again, it'll narrow down wider. In other words, it's not going to go as narrow as cloud and cloud servers and vaccine stocks. I think those days are over. I think we're going to start seeing, and the reason for that is earnings. The earnings quarter, which we're going to get into retail right now, is telling us that a lot of people, it's kind of like the whack-the-mole. The retailers were pounded, and they were hurt for a while, and they stayed under. But after a while, schools are starting. People are getting back to work. Even if they're working from home, they're still working. Financially, we had unemployment numbers yesterday. I didn't check today yet. I know it came out about an hour and a half ago. Yesterday, the numbers, the jobless claims number was substantially below the moving average. It was below 1 million. We were expecting 1.3 something. It was at 900 something thousand. So things are starting to pick up. We're starting to see expectations, but I don't think we're going to go. The only way we would go as narrow as we went before into the tech and biotech is if Moderna and all of these companies came out and said, all these vaccines we've been working on, all this stuff we've been talking about, it's back to the drawing board. And in addition to that, we're seeing a COVID-19 spikes like we've never seen before. If that happens, yeah, we're back to where we were. But that's unlikely. That's improbable. And as you know, the market discounts everything that's known. And the fact that we are seeing such a broad, two things, the broadness, the amount of broadness, homes, mortgages, all these companies, and that's how it should be. That's how the S&P used to be. It used to be very broadly diversified. When you would see the top 10 stocks, of course you would see patterns, but you would see patches. And now I'm seeing that again, and I'm getting very excited about that. But here's the other shoe that we need to talk about dropping. And I've been talking about this for several months now. And I know this is not your cup of tea. This is more of my thing, technicals. James, we are seeing the same type of narrowing of momentum technically that we saw on the NASDAQ 100 in January, pre-COVID-19. We're seeing that right now. We're seeing the RSI oscillator, the highs getting lower now for months at a time while price is getting higher. That's equivalent. To give you a good analogy, imagine you're driving a car, an 8-cylinder car at 50 miles per hour. and you're looking at that car from a distance. You're not driving in the car. You're just measuring speed from a distance. And now the car, the engine starts braking. The engine's now working on 6-cylinder, but the car's still driving 50 miles per hour. Now, if you're not in the car, if you're away from the car, you're just measuring the speed and it's going around the track, you don't know any better. You're still seeing the car drive at 50 miles per hour, but the engine is now working 30% more. And now 2 more cylinders go, but the car's still driving at 50 miles per hour. It's now driving 50 miles per hour on 4 cylinders. That engine now has to work twice as hard. If you're seeing it from the outside, you're not going to be seeing it. But I'm looking at it internally. And I've been looking at it internally since February. We went up to 95% of stocks on the NASDAQ 100 driving the market. We're now at 75%, and it's still moving at the same rate. If I was to show you the graph of the NASDAQ 100, February and now, you would say, Roger, it looks identical to what we were seeing prior to February. So the fact that I'm seeing the same thing from a narrowing of momentum, from an RSI level, from less stocks in the NASDAQ 100 causing the upside. So I am seeing, and then adding that, the fundamentals that I just talked about in terms of a broader S&P exposure coming out, more stocks, broader stocks moving higher, that's telling me from 2 different angles that the NASDAQ 100 needs to soften up substantially.
Sure. Well, it's fascinating to me that we haven't really seen, I mean, apart from that sudden correction in March, where we saw about 30% of the value come off of the S&P and the Dow in a very short period, which it has now 100% recovered. We really haven't had the relief valve corrections that sort of convey that the market is at least not 100% synthetic. When you see, a whole bunch of buying and the values go up, you expect profit taking, and that induces correction. But with the NASDAQ 100, that's been completely absent for months now, as it has been in the S&P. And so it's kind of disconcerting from a fundamental perspective, because that's not really something that we experience.
Right. It's not something that we experience. And again, look, the truth is we've never experienced, the market has never seen this type of a correction before, of a very lopsided correction. And look, it's going to take time for it to come off. But think about this. Let's say the market dropped. Let's say this was a financial downside. It wasn't a pandemic. It was a financial downside. It was a black market, black swan type of an event based on dollars. If that was the case, you would see most sectors go down and you would see a spike in utilities. Well, in this case, you saw a spike in tech because that is the utilities. That is the utilities for stay at home. How are people going to communicate? They don't have a phone. They have internet. I mean, this is the stay at home. The new utilities is technology. But again, as things cool off, the world goes back to its normalcy. And that's what we are seeing. But again, I think because it's a different type of a meltdown, we are going to recover in a different way too. But in my opinion, seeing the top S&P stocks being brought again is a very, very good step in the right direction, especially in light of earnings, especially in light of the fact that retail earnings are the last ones. Retail earnings are last, and now we're seeing these retail companies that have been hammered and hammered and hammered. We're seeing them not just rise, we're seeing them really screaming back, which is giving me good indication that things are starting, at least looking the way they should be looking. So I am hopeful that things will continue moving in the right direction.
Sure. This week we saw the S&P break its previous record of 3385 set in February 19th. And coincident with that, Roger, the price of gold plummeted by $100
on Monday. That's right,
5%. So when you're telling me that the market dynamics are making you feel better about the future performance of the market, is that going to occur at the expense of gold?
That's a great question. And that's actually something I was hoping you were going to bring up. I don't think so. And I'll tell you why. I think gold right now is in a mega rally. Gold has had a mega rally, I think 4 or 5 times in the last 50 years. And if you look at those mega rallies, there have been several times where stocks and gold have gone up at the same time. Now, with that said, I don't think we're going to see gold if the S&P starts coming off of this and things get better. And here's the thing, James, and this is something that Jeff Zanninari and I have been talking quite a bit about. Regardless of how things go, no matter if things go exactly how President Trump and the government and medical association wants it to go, this is not something where we can just snap our fingers and come out of. There's going to be long-lasting damage from this COVID-19, some of which we are not even seeing yet. 2-3 months from now, someone's going to come up with something and say. So I think this is going to be a very shaky ground for the next several months or a year. And I think anytime you have a shaky ground, and gold reacts the way it's reacting right now, I think you're going to see more upside. So I think it may not be it may not carry as much of a relative strength as it did over the past few months, but I think it may slow down its growth. But I ultimately think that even if we get out of this, I think the stock market is due for a choppy period. And I think we are at a period right now where we may consolidate before really moving higher. And also, James, even if we get out of this trade war with China, small caps don't stand a chance. So I think the stock market is going to have several more hurdles to jump through before we really into a beautiful bull market, so to speak. And I think it's going to struggle for some time. I think we're still going to have some amazing stock picks if you know where to look. But I think gold is going to be a winner for the foreseeable future. And when I say foreseeable future, I'm looking for a few years. I'm looking for this rally. I'm looking for a multi-year rally in gold and silver. As a matter of fact, as you very well know, when gold starts rising, the miners seem to have more of a leverage. They have a natural leverage. So, and I know this is not my strength. This is your strength. So I picked out 4 of the best miners that I'm looking at right now. I wanted to just kind of very quickly give you my opinion, and I wanted to just kind of get a very quick, broad feedback from you. Can we do that?
Absolutely. My pleasure.
Cool. Perfect. So the first one is Agnico Eagle Miners, AEM ticker symbol, one of the strongest performers in the group, and delivers mines as promised while keeping controls intact. What do you think about AEM?
Well, I've followed Agnico Eagle for over a decade, almost 2 decades, I suppose. I've met all of the CEOs over the last 2 decades, and I don't believe I visited any of their mines, but Agnico Eagle is one of the Canadian sort of crown jewels when it comes to mining companies. And it overcame a series of major setbacks earlier in the last decade. They had a problem where one of the rock mechanics at one of their main producing mines in Quebec actually caused them to have to abandon the mine. It was misdesigned, and everybody thought that was maybe going to be the end of Agnico Eagle, and that's the big swoon in their share price that also happened to coincide with the sell-off in gold from 2012 to 2017. So it looked like, Agnico Eagle was a falling star, was going supernova, but then the CEO turned it around, and he really prioritized quality assets and without hesitation shed the less profitable ones and transformed the company into a rising star again. So Agnico Eagle, oh yeah, that's a slam dunk.
Good. And one more, and I think you probably know this one. It's Kirkland Lake Gold, KL.
Well, Kirkland Lake was a recommendation in our newsletter back in 2014, I think, 13. And there's interviews on our site with the CEO from back then. And so Kirkland Lake Gold, yeah, another great story. Deep vein system that's very high grade, and they keep extending it in multiple directions. and yeah, improving cost structures due to the great increase. And
they just bought, they just completed the acquisition. Sorry to interrupt you. They just completed the acquisition of Detour Gold, just FYI.
Right. And Detour Gold was itself one of the largest projects in Canada. That was a crown jewel. And so that was a merger that was really really watched, because it was kind of a surprise. Kirkland Lake made basically made the transition into a larger diversified asset miner, away from the single project miner that they were in the Kirkland Lake gold mine. So it was a surprise that they got Detour and not the likes of Barrick or Newmont, or one of the 5 major gold producers in the world. So again, Kirkland Lake's demonstrated a sort of canny dexterity when it comes to the operation of their company that I don't think any investor is going to get hurt by investing in that.
Good. And I have one last question for you. What percent, and this is something I really think our investors would be interested in. I know that Turkey has been getting a lot of attention for mining in the last couple of years. Do you think that is sustainable? And it's based on all the geopolitical stuff that we're seeing and all the things around the world. Do you think we're going to see more out of Turkey in the foreseeable future?
Well, Turkey is one of those jurisdictions that is underexplored and underdeveloped in terms of its precious metals resources. And in each gold cycle, there's the inevitable group that flocks to Turkey and takes over and dusts off one of the old mining projects from one of the last miners. And the problem with Turkey is that they permit the continued exploration and therefore the increase in value of the project. But then when it comes time to put it into production, all kinds of issues suddenly crop up. And I've seen so many projects abandoned in Turkey due to geopolitical interference, usually associated with permitting, that it's kind of, as soon as I hear Turkey, the hackles on my neck go up, and I think, I'll have a look. But Turkey has not historically been a reliable deliverer of shareholder value due to the geopolitical uncertainty and the dubious nature of the rule of law in Turkey as it applies to property and ownership. So, but mind you, we live in an era where the concept of the rule of law as practiced by governments is in question everywhere. So I don't know. There are groups and teams that specialize in extracting shareholder value from difficult jurisdictions. I'm involved with a company now that's acquiring a 50% interest of a project in Liberia, which many people hear Liberia in Africa and they think, oh, I'm not going anywhere near that. But those projects in the right hands have historically been able to, yield value. But there's the added risk of that kind of situation. And so usually that's priced into the stocks that are operating there, depending on the weighting of the importance of the asset in such a jurisdiction to the entire portfolio of the company.
Got it. Gotcha. It's really good because a lot of our readers right now, James, are getting into gold and silver, and they have a lot of these questions. And I really want to thank you for taking the time to share this information with me. It's going to be very, very important and valuable to our readers.
Yeah, well, you bet, Roger. It's my pleasure. And with the return of the strength in the gold price, I mean, I was persistent in my calls for $2,000 gold from 2011 right through to the 2017, where I finally just got fatigued and I just stopped talking about it, because every time I would mention gold, I'd lose a dozen subscribers. It was that much out of favor. So, it's like it's famously said, it's difficult to predict I can always predict the future, just don't say when. And that's certainly the case with gold. Now it's been through 2000, it's back below 1900. It looks like 1900 range is the new base. And, obviously there are many aspects of the price of gold and the price of gold miners and ETFs that make it an increasingly complex asset class. And predominantly, governments go a long way towards trying to convey the idea that gold is not money. if you travel across the border where you're supposed to declare anything as a monetary unit with greater than $10,000 in value, if you have a 5-ton statue of gold, it doesn't qualify. You don't have to declare that as a monetary unit because it's not money by order of the government. So, and yet they focus so much effort on ensuring that the gold price is under some kind of control, depending on the level of conspiracy you buy into with that. But there's been patterns in the futures market, which even Eric Sprott acknowledges, and says, you know, there's a futures market, a future price of gold determined by the sale and purchase of paper gold for which delivery is never fulfilled does not fairly constitute a determinant in the future price of gold. It determines the price, but it fails to convey the value. And that is the situation we have today. You saw the price of gold go down by $100. Did the price of gold go down by $100 at your local bullion dealer per ounce? It did not. It remained stable, and in fact, continues to exist at a premium to the quoted spot price on any given day by as much as 10, 12% in some cases.
Or even more.
Yeah, so that, you know, the era of gold, I think, as a monetary unit, and the fact that it's not designated as such is the greatest opportunity for investors in the space, both for protecting wealth in the form of physical gold, but also in the form of being able to speculate and profit on future values of gold companies as this new gold wave starts to capture the imagination of the broader market.
Precisely.
Which always is a process of a number of years. So I'm so glad to hear you talking about gold. It warms my heart.
And in the next few weeks, hopefully you'll be able to give me some of your time, and I'll do the same thing with some silver companies as well.
Fantastic. I'm looking forward to that, Roger. Let's leave it there for now. We'll come back to you next week. I look forward to seeing you at the round table on Monday. I hope you have a great weekend.
Thank you, James. It was a pleasure. I'll talk to you guys soon, and thank you for having me on.